Good afternoon, everyone, or good morning, depending where you're joining us from. We're so excited you're here with us this afternoon or morning. Today, we'll be talking about outsized challenges demand creative solutions, expanding outpay through debt financing. Now, I will pass it over to our moderator this afternoon, Kathleen Enright.
Why, thank you so much, Manuela, and welcome here, everyone. I'm Kathleen Enright, the President and CEO of the Council on Foundations. I really appreciate you spending a little bit of your afternoon with us for this webinar on expanding payout through debt financing. I want to start off by thanking the incredible Council team, particularly Daniela Rodriguez-Ramp, who was a terrific partner in getting this set up. Well, so we all know that in these incredible times we're in, we're looking for creative ways to respond to these deep-seated racial inequities that we're facing, to the devastating effects that COVID-19 and a myriad of other natural and man-made disasters have caused across our nation and around the globe. So the widening inequities, everything that we're facing really demands creative solutions. So for years, foundations have been getting more and more creative about aligning our financial assets with our missions and values. We've been doing things like program-related investments, mission-related investments, screening our portfolios for social issues, the divest invest movement, banking with social purpose banks, et cetera. The list goes on. And Ford Foundation's debt financing approach to increase payout levels is another really creative way to get a greater percentage of our philanthropic capital to move mission. And, it's a particularly smart one, I'd say, in this environment with historically low interest rates. So I bet you many of you have already read what was in the press. There were some things in the New York Times and in the Chronicle on philanthropy. But Ford was not alone in this effort. There were 4 other foundations that joined in this approach. They did not all pursue the exact same approach, though. The other foundations were MacArthur, Kellogg, Doris Duke, and Mellon. I think Ford definitely did a social bond, and they can share whatever details they'd like about what the others ultimately did. But I know personally from conversations I've had that other foundations are moving forward, including the Bush Foundation in Minnesota. They've already gotten board approval to move ahead. And the interest on this call alone shows that many in philanthropy are considering creative debt financing approaches as well. Actually, if any of you are on the council's email, just moments ago, we released a survey with Dahlberg and Philanthropy California that has some interesting data about this in it. We were wanting to see whether folks were increasing their payout and how, and 2 pieces of data that I'll share now that it's public. One is that 36% of those in the study said that they already have or are just about to increase the rate of their endowment payout this year, which is pretty great. And 7% said that they were going to be engaging in debt financing. That number seemed huge until I did the math. That's about 18 organizations in the study. So that is it feels more reasonable when I calculated it out. So we're incredibly lucky to have the architects of Ford's deal here on the line with us. We're hoping that Nishka Chandrasoma will be able to get on by video, but she's already on the phone with us at the moment. She is the Vice President and Board Secretary and General Counsel for the Ford Foundation. She's responsible for managing the overall legal affairs of the foundation, everything related to governance and grant making and global operations. And look at that appearance that she makes just in time. Nishka, lovely to have you here. It could not be better, I don't think. And then we also have Eric Doppelstadt. He's the Vice President and Chief Investment Officer. Eric is, you would probably guess, is responsible for managing the foundation's investment portfolio. He has long been involved in a variety of alternative investments, including creative financing options. So, Eric, thank you for being here. We're so glad to have you.
Thank you.
And then finally, Mayan Tran, who is the Chief Financial Officer. And as you would imagine, as all CFOs are, Mayan is responsible for the overall financial health of the organization and Ford's financial future. So welcome to all three of you. So glad you're here. Well, just in terms of the course of events for our time together, for everyone who's on the phone, we are going to do a detailed Q&A because I bet you many of you are finance and investment sophisticates who want to ask detailed questions, and so we are going to be here for that. We have a full half-hour Q&A at the end, and I will even be inserting some of the questions that you included in your registration during this initial time. So please just put them in the chat box and we will make sure that we get as many of them answered. We will just be staying on this in this format for the entire Q&A. So let's just absolutely get started. So Nishka, we're going to start with you, and you are going to just give us the basics of the story behind this decision. How did you kind of get to this place where you were going to increase payout through debt financing?
Hi, Kathleen. Thank you.
Oh.
Can you all hear me? No? Oh, yes.
Yes,
okay.
Good. You're just slightly delayed. There you go.
That was harrowing. I'm very thankful for my resident spousal tech support, and I'm glad that worked at the 11th hour. But thank you so much for doing this. It's really great to be here. And I don't think I have too much of really an inside scoop to share, more than what was reported really in the Times and other places. We're pretty transparent, so what you see is kind of what you get. And it really was about the total uniqueness of this moment, a global health crisis, a financial crisis, the racial justice issues, and now, you know, a natural disaster, an election. It just feels like as a funder, any issue that you might care about is really implicated in this moment. And so many of our grantees are both being financially impacted and they're more critically needed than ever. So right when the pandemic hit in New York, Darren, our president, and all of our program staff were hearing from grantees who were so fearful about the impact of the coronavirus on their operations and their fundraising. And you know, these are the organizations that are providing critical services to the very communities that are most affected, communities of color, restaurant workers, domestic workers. And we had this sense that without a significant intervention, they might have to go away. They might have to close their doors forever, and we would lose their services that they provide, we would lose the jobs that they create, and it would be this truly unprecedented crisis in the sector. And at the same time, we were hearing from foundation leaders who wanted to, understandably, given that their endowments may decline in the next few years, wanted to protect their endowments and were thinking about you know, shrinking spending in the coming years. And that's a completely understandable and very typical response, given that we all, you know, we do our payout based on endowment value. And it's the rational response, but at the same time, it does mean that right when the needs get most severe is really when a lot of foundations think about shrinking their giving. So it was this sort of inherent tension, this kind of catch-22 between wanting to exist in perpetuity on the one hand, and then really respond to the very immediate societal need right now that led Darren, I think, to think of an innovative way to sort of do both. And the bond financing really was the answer to that, to be able to respond while preserving our endowment. So that's a story as I know it, but you know, Eric and Mayan may have more of the inside track on what those conversations look like. So I'd love for them to chime in too.
Yeah, Eric, what was your take?
No, Nishka captured it perfectly. I think it really was a combination of external factors and our judgment about the needs that our grantees faced, in particular at a time like this. And in the early days of our conversations about this, we noticed that even extremely well-funded organizations like the Metropolitan Museum of Art in New York or the Museum of Modern Art were closing programs, laying people off, taking other severe steps in response to this. And those are organizations that presumably have access to significant donation inflow, unlike many of our grantees. So that really underlined the urgency for us, as Nishka mentioned, of being there for our grantees, because as Darren, our president, repeatedly said, this really was an extinction event for many of them. And it was a once in a lifetime crisis that, in our view, demanded a once in a lifetime response.
Well, I hear so much of a mission focus coming through when we're here to talk about a financing approach, which I really appreciate. And wasn't there something in Darren's background that got you here? Isn't say a little about that.
Darren had a background, of course, he has a remarkably varied background, which included a stint practicing law in New York, but he also worked at UBS for, I believe, 7 years. And so he has a deep familiarity with the workings of the financial markets, in addition to his work in the nonprofit sector and the foundation sector. And I think that helped him to see very quickly the argument for accessing financing in this way, as opposed to taking all of the increased spending out of our endowment.
That was something unique that I was remembering from, I think, one of the articles, just that connection between the mission and the background in finance. Mayanne, were there other approaches that were considered beyond debt financing? You know, I hear the mission piece coming up, and then how you get it done. There's probably a lot of opportunity and approaches potentially out there. You're muted still, lady.
Oh, thank you. I think I was muted. You know, I mean, this is Eric said once in a lifetime. I think it's once in a century moment in time. And so, you know, once we realized that we really were facing an extinction sort of event, and that our grantees might just not be around following, you know, world post-COVID, and we knew that we had to increase spending, there were really only two options. It was either to take the money from the endowment now at probably the worst possible moment in March, when the financial markets were just falling apart and we didn't know what was happening, or it was to access the capital markets. And, you know, we could have looked at a bank loan. In fact, we have lines of credit lines of credit that we had access to. You know, there were definitely different instruments that we could have looked at. But we decided very quickly on that it was just better to do a very long-term bond financing that we would just pay either 30, 50, 100 years. I mean, at the time it was like the longer the better, you know, and leave the money in our endowment with Eric and his team, have that sort of, you know, the endowment grow, and then in 30, 50 years from now, pay it with basically 30 to 50 year money. I mean, it was, you know, the math was the time value of money and what you could do with it and the opportunity costs. And then also just being able to access the funds now and put it in the grantees' hands just to survive this moment. It wasn't even to expand programs or expand, you know, anything. It was just to survive this moment.
And Kathleen, if I could just add, just for everyone's understanding, we're not kidding ourselves, of course, that our bond offering is free money in any way, that taking a step like this is free money, or that we haven't somehow reduced the value of our endowment, because, of course, in accounting terms, we have reduced the net asset value of our endowment by $1 billion. However, if you look at our decision to issue debt in economic terms, not just accounting terms, relative to the alternative of taking $1 billion out of our endowment today, we believe that this was a very compelling opportunity for us. Part of it had to do with the remarkable conditions in the credit markets that you referred to at the outset that enabled us to access both a very favorable credit rating and also extraordinarily low borrowing costs. But I think it also had to do with, if you really look at the cost of taking $1 billion out of our endowment now is effectively permanently and immediately reducing the spending power of our endowment in perpetuity. But because we were able to borrow a fixed dollar amount of debt with extraordinarily low carrying costs and for an extraordinarily long term, namely 30 years and 50 years, we think this was very advantageous for a few reasons. First, we do expect to earn returns of higher than our blended debt cost, which was 2.6% over the next 50 years. And at the same time, and I think equally important, we think it's a near certainty that over the next 50 years, the dollar's value will be massively devalued by inflation, as it has been over the last 50 years, when it's lost about 80% of its purchasing power since 1970. Therefore, between the returns that we expect to earn on the endowment over the long term of this debt and the ability to repay the debt in very depreciated dollars, we believe that we can offset most, if not all, of the real inflation-adjusted cost of this debt before or by the time we have to repay it. And that would make it a very good deal for us. That's really, in a nutshell, I think, the way that we thought about the alternatives and the costs and benefits of each.
That's terrific. I think you just made all of the investment folks on the call very happy with that answer.
Maybe not, but
no, I'm sure you did. Thank you so much. Well, I wanted to talk a little bit about the governance stuff. Mishka, you know, this was, I mean, and I think that Eric got to this a little bit, but this is about the, you know, the philosophy of the board and, you know, the tension between the needs of society now and the needs of society in the future. And you've mentioned multiple times about, you know, once in a generation, or not even once in a generation, once in a century type of problems or extinction event, you know, so it seems very, very clear to you, you know, the situation you were in. But did it seem as simple to the board? How, you know, how did that go in the board conversation, or what challenges came up?
You know, by the time we got to the actual board meeting, it was a fairly easy conversation and an easy decision, but it wasn't easy leading up to it. There was groundwork laid both for this particular transaction, but I would say more importantly, there's been groundwork laid with our board over several years now of Darren's tenure and a really great trust that the board has in Darren's leadership. So, you know, I do think this would have been hard to do for someone that was a new foundation president, you know, with a new board trying to launch something like this. But for us, given that the board had that trust in Darren, this is not the first big idea that Darren has had, and he's shown that he's been able to execute them, you know, thoughtfully and carefully. And he also, you know, when he came to us, those on his leadership team, we all, I think, had a healthy amount of skepticism, not because we wanted to say no to Darren, but because we really wanted to kick the tires and make sure that we had thought through all the potential pitfalls. And so when we went to the board, we were able to lay that all out, lay out the pros and the cons, all the other options, the near-term and longer-term consequences on the endowment, as Eric said. And it was clear that we had done that preparation, which is what made the conversation a little bit easier than it may otherwise have been. And we also, you know, we did frame it in terms of the risk of not doing something, not so much sort of, just the fiscally prudent choice of just trying to safeguard our assets, but really what that would mean for the sector, the financial and social ripple effects that could have on our society, and the fact that then in the long term we would have a larger societal problem that really who's going to deal with, right? I mean, foundations would be called upon then again to respond, perhaps in a bigger way, perhaps at a time where their intervention maybe would mean less. So we did try to frame it in those terms. We do have financially savvy trustees on the board, and it was really helpful. I think, you know, if your trustees are less familiar with capital markets, less familiar with these types of transactions, they may shy away from them. But we did have a handful of trustees who had that expertise, who were able to do the financial analysis themselves, get comfortable, and then, you know, reassure the other board members who may be less familiar. And I think we also provided a couple of other points of reassurance to the board, as Mayan said, the fact that this is not going to be a habit. We're not going to do this all the time. We have done it once before. We did issue bonds to renovate our building a few years ago, but we really expect this to be an unprecedented thing, a once in a century thing. We're not going to be issuing debt all the time. So we stated that very explicitly. We're also not going to be increasing our headcount to give this money away. We're not, expanding our own operations. We are doubling our grant making budget this year and next year, which is no small undertaking, but we are mostly making large general support grants to our existing grantees. So in terms of due diligence and administrative effort to do that, we can do that fairly efficiently with our existing staff. So we did provide that reassurance, and we just sort of laid out all the options and tried to be very explicit about the trade-offs, and I think that was helpful.
Well, so what were some of those sticking points when you were playing devil's advocate, or trying to push hard to make sure that this was a good deal, or when you were in the boardroom when those savvy board members were pushing hard? What were some of those sticking points?
Yeah, I think so when it was decided that we would increase our grant making by issuing debt, then it became a matter of, on what terms. And do you pay it all back at the very end of 30 or 50 years, or do you pay it back over time? Because as Eric said, it's not free money. You do have to repay it at some point. And you do have to make provisions for it. And whether you do that in the short term or the medium term or long term, that was definitely a discussion with the board, because as Nishka also mentioned, we do this once in a century, and when the next, hopefully, if something were to happen again that's similar in size, we wouldn't be able to repeat this action. We would have to think of another creative way to do this. And so that was a very important decision that the board made, that this was such a crisis that we would have to sort of make this decision now and maybe perhaps hamstring future generations, not only with potential future actions that they may or may not act on, but in 30 to 50 years from now, they do have a bond that they either need to pay back or refinance. So it's definitely a conversation about the now versus the long term. It does also increase our financial risk profile. I mean, we do have debt now that we have to service, so we not only have to pay interest, but we also at some point we need to deal with it, not only just this bond, but also the bond that we issued for the building. And so those were all conversations that we had. I mean, as Nishka mentioned, it was helpful to have a lot of sort of sophisticated board members that are very comfortable with capital markets. With issuing corporate debt was really helpful as well, because we have a couple of board members who are sort of more heads of corporations, and so it's risky, right? If you're not used to having debt, which we didn't have before 2017. It's a completely different financial profile that we now face. And so those were important conversations that we had with the board. And, at the end of the day, that was the decision that we made that was right for the Ford Foundation to issue a very long-term bond. And I have to say, Mellon MacArthur and Kellogg, I'm not sure about Kellogg because they haven't gone yet, but, their calculus was different. They were issued, I think, smaller bonds, shorter term bonds, and they are planning to, sort of repay them over the next 5 to 7 years, and whether or not that it impacts your future grant making, that's unclear. But what we wanted to do was put this money out and then not impact our future grant making, right? And so we would continue with our grant budgets just the way they are in the next 2 to 3 years, as if it's these bond proceeds were literally characterized as supplemental grant making, not in lieu of future grant making, and that was the decision that we came to with the board as well. And that was an important one as well.
Well, let's go a little deeper on that, because you kind of kicked us off about the basics of the deal that you structured, both how it's going to impact your grant making now and in the future, and financially.
So there are many ways we could have structured this, right? We could increase our grant making now and reduce it in the future, reduce it either by the amount of grants that we make now, or reduce it because we have to pay interest, on this bond, reduce it because actually under the eyes of the IRS, we will have more than met our payout for the next probably 5 years. And as a foundation and as the board and with Darren's with Darren's support, that is not what we wanted to do. We wanted to just continue our grant making the way we always have and support our programs the way we always have. Our thesis was that literally the grantees that we were funding in this moment of COVID were not going to survive. And so, as Nishka mentioned, it was just general support grants to supplement the grant making we make now and in the future for them to survive or replace funds that they would have lost otherwise, and for them to just stay in business and stay the course. But it was a discussion that we had with the board that we remain committed to our ongoing grant making and our ongoing spending. And so, in the future, our payout will probably be a little higher than it would have been without WANDA. Without the social bond. That's another story.
I think you have to tell. I know what it is. So you have to tell. It's kind of cute.
Oh no!
Code name, right? It's the code name.
It was our project code name because during the conversations that we had with the board, we wanted to keep this very confidential. There was a lot of sort of work that went in terms of when we went public. There were a lot of there's a whole strategy to communicating this. And so if and when you come to our building, when we reopen, when you first walk into the lobby, there's this beautiful painting, and I forget the artist's name.
Hinde Wiley.
Thank you.
Hinde Wiley.
Yep. And it's the same artist who did the portrait that hangs in the National Art Gallery of Barack Obama. And so it's a portrait of this fierce warrior, woman, and the model for it is this woman, Wanda Crislow, she's a person in New York City who has now, I guess, gotten famous through us. Sorry about that, Wanda. But it was actually Darren. Darren named the project Wanda. That's the backstory. So there's a beautiful picture. I think it ran in the New York Times. A beautiful picture of the painting with Miss Crislow and with Darren side by side with these like beautiful smiles. It's a beautiful picture. But that was Wanda. But our social bond.
She is immortalized in many ways. That's true. Eric, what else would you add? Well, Mayim, were you done?
Yes.
First of all, Eric, what would you add to the kind of parameters and basics of the deal that Mayim shared?
I think she said it well. The only thing that I would add is that we were fortunate to be able to access a AAA rating from S&P and Moody's. That was very important to allow us to access a large amount of demand in the bond market for AAA bonds. And because of the nature of the transaction and the rating that we had, we were able to issue unsecured debt. That was also very important. Mm-hmm. And the debt that we issued does not have any substantial covenants or restrictions on our ability to operate our business or our investments, our grant making as we choose to do so. Those were very important parameters because it's also possible that there are many sources of debt that are out there, but not as many sources of debt that come without a lot of strings and restrictions on the borrower. Mm-hmm. So this was something that made a big difference for us in making the decision to go forward in the way that we did, that we could access unsecured debt through the public bond markets, and therefore we had a lot of demand for our bonds because there is a shortage of AAA rated debt, especially with the maturities in which we were issuing them.
Yeah. And we were really clear also. Sorry, Mayim. We were clear also that we weren't going to use the proceeds for sort of specific COVID-19 response grant making. That was a question that kept coming up because we were issuing the bonds in response to the pandemic, but we weren't going to be funding a vaccine. That was not the point. Mm-hmm. The point was really to continue to do the same kinds of grant making that we have been doing to try to disrupt the root causes of inequality, which have been heightened by the pandemic. but we were very insistent, as Eric said, not to have any strings attached to our grant making. But we did issue the bonds as social bonds, as Mayanne mentioned. They are ESG designated, and we went through a process with a third-party opinion provider to give us that designation. And I think when we first learned about that option, all of us were sort of like, well, why do we really need to do that? We're a foundation. Everything we do is charitable. Don't people know that? Why do we need this special rating, this special designation? But it worked out really well. We're really glad we did it because it did increase the marketability of our bonds to ESG focused investors. And it's surprising, but we were the first foundation to do that. And that's just, I found that really kind of shocking because everything that foundations do is charitable. So you would think that someone would have thought to issue a social bond before, but we were the first to have done it. And that was a kind of a nice thing to add as a new learning as part of this experience.
Yeah, absolutely. Well, it puts you in a category, right? It puts you in a category that the folks who aren't, all they're doing is looking for the category could scoop you up, right?
It did. It drove a lot of demand, and it actually drove a lot of interest, and it did drive down the ultimate coupon rate that we're paying on the bond. We spoke. I think there were half of our bonds were basically sold to ESG investors. That's how we actually allocated the funds. There was so much demand, just from investors in general, but also ESG funds, because there is not a lot of AAA social bonds out there. I think there's a lot of corporations that issue either green bonds or social bonds that are not necessarily AAA. And so for us to come out with a AAA, with a third-party designation, not just calling it, that, and having gone through that process really drove demand. And, and the other foundations have followed. So it's been really great to see, to have sort of a double effect to actually advance the field as well. And so that was very exciting for us. And as Nishka mentioned, yeah, we were actually more than just a little skeptical. But once we understood what it was, we thought this is great, and we very quickly caught on that we could actually move the industry.
That's, I mean,
very
it's good to kick the tires, ask all the questions. That's not a bad thing. I'm sure you made it better in the process. So Eric, I don't think you fully, I don't know if maybe you said this and I didn't catch it, but for all the lay people, what percentage of your total assets was the bond? Did you say that? I don't know if you did.
I didn't.
And then what is it going to cost you overall? Like those two questions, it's like netted up for us CEO types who can't, do that math in our heads.
I can take this one. Oh, good. Unless you want to, Eric.
No, that's good.
And it represents about 8% of our total assets. So it's a very small percentage. And the interest that we pay on it is about $27 million a year. It's on on $1 billion. That's pretty good terms. And then it's payable. 300 million of it is payable in 30 years, and the 700 million is payable in 50 years. And the next generation may choose to repay it then, or make preparations in the sort of future to repay it down, or they might choose to refinance it as well and do the same thing we did and have a bullet maturity as well and just keep rolling it forward. But that's for the next generations to come on that. There's an important ratio that rating agencies also look at. There's two of them actually. It's your assets to debt ratio. So we were sort of more than 10 times covered. So if you look at our total portfolio and you divide it by our total debt, we were just 10 times that. And then also what's called interest coverage, which is how much of your income do you have to cover the interest expense. And so we more than cover our interest expense many times over, depending on the year and depending on the income that we make. But those are two important ratios that any investor looks at, not just the rating agency actually. And so obviously the less debt you have, the less you have to pay in interest rates.
That's terrific. Thank you so much. I'm betting that these are all questions that the audience is desperately interested in as they're thinking about it for themselves. And so I wanted to move on to those kinds of questions. Well, first of all, what else did I not ask you about the Ford situation that I probably should have asked you? Highlight other things.
I think you covered it well, Kathleen.
We'll get to more good stuff. We'll get to more good stuff. But I wanted to, I know that you are getting so many questions from so many interested parties, and I have a lot of questions from, you know, I think one of the biggest ones is, oh, but you're the Ford Foundation, right? You are so big, and, you know, you've got this name and all of that. And so, you know, there's this whole set of questions about translatability, right? How does this translate to an organization that is, you know, 5 times smaller than you, or you know, maybe doesn't have a team that has an Eric, a Nishka, and a Mayan on it. So talk through how you've been advising folks who call you with those kinds of questions.
Can I just, yeah, I wanted to just make one other point. Sorry, I forgot, Kathleen, I was looking at my notes, but you know, a public bond is not something that works or fits for every organization. It comes with, you know, you have to have some amount of scale to be able to issue, you know, a minimum size, and I think, you know, 50 million is probably the minimum. You know, investors like to see, actually, they like to see a benchmark size. So they like to see a $300 million bond because it gives them liquidity when they need to sell the bond. And then there's ongoing costs, right? Reporting and not in costs. So we have to maintain you know, rating with both Moody's and S&P now. And then there's, you know, some fees that come with that, and fees with a bond, you know, registration company. So it's not, I don't think it's, you know, it's not the solution for every organization, but definitely accessing some level of capital markets, whether it's through a bank loan or it's through a private placement. There's other similar structures that you could explore that don't necessarily, you know, have to be a public bond. And then there's other ways to use your balance sheet as well. Like, you know, so we also have a PRI program. You can do loan guarantees. And so it's just a different instrument that you can be creative with. And so, you know, to your point, Kathleen, we are the Ford Foundation. I mean, we just, you know, if you think about like a distribution of like size and you know, we're just off the charts, right? We're just, you know, we're always sort of the outlier. But that's not to say that, you know, a public bond couldn't be for other organizations, but you do have to have a certain size for it to be economically, you know, sort of economically make sense for you.
But okay, so 50 million is the floor. That's good. You gave a number. People are going to like that. But what about like pooling together? You know, would it make sense for, you know, 10 foundations to come together to pool, you know, to issue something, or is that too complicated?
It definitely, for a public bond, I don't think it would be, I don't know if it would be impossible, but I'm pretty sure it'd be pretty close to impossible because, you know, an investor is looking at a credit and not sort of a joint credit. You know, I would say, you know, you know, another vehicle would be a bank loan as well. But, you know, when you start to pool funds together and you sort of, you know, have creditors that are jointly tied, there's probably a lot of documentation and a lot of sort of coordination and a lot of negotiation that might not make sense.
You need sort of a new entity, right, Mayan? You need to set up, you are going to aggregate, you'd need an entity to sort of be the vehicle for it.
Or whatever, yeah, that makes sense.
Yeah.
All right, that's helpful. So you know, the minimum size would be 50 million, and if you do that at your 8%, then you do the math about what asset size would need to be, which I can't do in my head, but 10% easy is 500. So, all right, yeah. So there's a lot of foundations that are about that size.
Yeah, and sometimes it might make sense to talk to your bank and get a bank loan as well. I mean, you know, I think so for most banks, I think over 200 million, they usually have to syndicate that loan out, but they can less than 200 million, most banks can do that off of their own balance sheet. That's certainly been the experience we've had. And so, they might be able to offer, more favorable terms, or certainly if you have a banking relationship with them as well, that's helpful too. So I think some of the smaller foundations that I spoke with are looking at that to leverage that. It might not be 30 or 50-year terms, but at least it might solve for some immediate grant making needs that you're looking to do.
Yep. So you're saying small foundations, just a bank loan, just easy as that. Nothing too complicated. It's because that's some of the big questions we were getting from folks. It's just like scalable for small foundations. What else about the board or the governance questions that you thought would come up, just in terms of the near and the long term? I'm interested in the fact that you landed somewhere very different than the compatriots who came into this deal with you. So talk us through that a little bit. Like I'm talking about MacArthur and Kellogg and others.
Yeah, it is really interesting that we ended up with such a longer term bond. And it might be, to my aunt's point, if we had more board members who were familiar with doing this either in their corporations or universities who issue this kind of debt. We have a lot of trustees who are also on university boards or who work at universities, so maybe it was just more familiar to them. The other thing, I think that there's something about the possibility of putting something this further into the future, as opposed to invading our principle now. For a foundation like Ford that's been around, we have been around so long, you know what I mean? Like, I think the concept of perpetuity is really real for us. We've been around since 1936. It really is not a live conversation for us whether we would spend down at any point, and our board is completely independent, and they all serve for a limited number of years. So you can imagine that for a board of a limited period of time to make a decision, to essentially take a lot now out of the endowment at the expense of future generations and future needs, when they're a board that just exists in this particular moment, that feels like a very consequential decision, a very monumental decision. So that might have something to do with it, the idea of really not reducing the corpus and trying to preserve as much as possible. And obviously over long term, there is a cost, as Eric said. This is not free money, but there are options, and economically it made sense for us. So that's really all I have to say. I don't know. I found that really interesting too, that we ended up in different places. I don't know, Eric, you might have talked to their CIOs and have more of a perspective on that.
Well, I think that, as Nishka said, everyone can look at this in a different way, and some other institutions might well be concerned about bequeathing debt to later generations and felt like it was more responsible for them to repay it. That also, though, influenced the amount of money they were likely to borrow. They tended to be smaller transactions that they felt they could more easily repay. One other thing I would mention that just underscores the fact that we manage ourselves in a fundamentally mission-driven way involving our finances is that another question you will face if you do a transaction like this is, where is the debt service cost coming from? And we made an explicit decision in planning this transaction that we were not going to reduce grant making in any way to make room for the cost of this debt that is being borne entirely out of our endowment, not out of our grant program. So there's no backdoor reduction in grant making, either now or in the future, to accommodate for the cost of this transaction.
It's amazing. These are all terrific mission-driven decisions that I'm loving how, we've got the finance people and the lawyer up here talking mission first with every statement that you make, which is
the other thing I'll add, just as a point of interest, that so we issued this debt in late June, and the tranche that Mayan mentioned of 50-year debt was issued at a rate of 2.815%. That bond is trading today at 2.57% to yield 107. So it's already traded up by 7%, and the yield has fallen to that even lower level. It just shows you that the credit markets are even more wide open now than they were when we did this transaction. So if someone else is able to access a bond issue like this, this is an exceptionally favorable time to be issuing long-term debt.
It's not making you want to go back and do more, is it? Mayan's like, well, maybe. You're not on mute. I saw it in your. I saw it. Well, so there were some questions that came in when people registered about the legal, the legal aspects, Mishka, that were just, I think it's just from the perspective of, are there many and what are they? And, particularly anything to do with tax status, are there things you bump up against? So just, talk us through what you were worried about and whether or not that materialized.
Sure. Yes. I mean, it is a complicated transaction. I don't want to minimize that. And you definitely don't want to do it without talking to competent outside counsel. But I would put into sort of three buckets the types of things that we were concerned about and looked at. On tax, we weren't really worried about impact on tax status because we were essentially borrowing to carry out our charitable purposes. So there's nothing that really should impact our 501c3 status. But you do have to be careful when you're issuing debt that you don't end up with debt-financed, unrelated business taxable income. And so, you want to make sure that the bond proceeds aren't deemed in any way to be income generating. So they're not seen as being used to fund investment activity, because then the income from that investment activity would be considered UBIT, or unrelated business taxable income that you would have to pay tax on. So there's a whole process that Mayan, is very careful about making sure that the proceeds of the bond are segregated and only used for the grant making activities, the supplemental grant making. So you can really kind of follow that money through and make sure that you don't have any tax consequences. But it is really important to structure that very carefully. Eric already made the point about covenants, so that is something to be careful about in your bond documents, that you don't end up with a lot of covenants that are burdensome. And then, of course, there's the whole governance piece of it, the oversight, the kind of state law prudence type issues. You want to make sure that this is a prudent decision, that your board has exercised all of their fiduciary duties, that you've provided all the right information to their board, so they're making a reasoned and careful decision. You want to look and make sure there's nothing in your charter and your bylaws that would prevent you from doing this, that you don't have a spending policy or a debt policy that would curtail it in any way. So, all of that kind of general corporate housekeeping, good health type of issues. And then, for us, I think, for me, I'm not a securities lawyer. Mayan and Eric sort of are much more familiar with this type of thing, but foundations don't go out, with public offerings all the time. And there are a host of sort of securities law concerns around how you talk about it, how you discuss information about, yourself as an entity before, in the sort of weeks leading up to your offering, that you need to be careful about and might sometimes kind of fly in the face of our usual instincts to be really transparent and tell everyone what we're doing and how we're doing it. So we needed to constantly remind ourselves of those issues. I think those are kind of the principal legal and tax challenges. Mayan, was there anything else that I left out?
No, those are great. Thanks, Mishka.
That was really helpful. Well, we promised the audience kind of a bifurcated conversation, one that was sort of the big picture and then sort of drilled down into a deeper Q&A. So I'm going to ask all of you just a final question to wrap up the first hour, and then we'll go into even a deeper Q&A with anyone who's interested in sticking around. And I've got the questions that folks have been emailing in, and I will take all of the rest that anyone else wants to send in through the chat. But just the final question for these terrific panelists is just what is any either piece of advice you have for the group, or something that you wish you knew on the front of the process that you know now that would be helpful for anyone who's considering a vehicle like this? So Eric, I'll start with you.
It's important to have a very good general counsel and a very good CFO. That's what I would say.
Partners like these ladies, I think everybody wants. That's a good one. Excellent. Mishka, from my end.
I think if I had known that Darren wanted to do it in 6 weeks or something, I might have pushed back a little harder at the beginning. We did it really fast. We were lucky that we had done it once before, and so we had a template. But it was sort of a whirlwind, and then the money ended up in the account, and we were like, oh my gosh, now we have $1 billion, and we have to spend it. So I don't recommend that timeline, but at the same time, we are responding to an urgent need. So we weren't going to do it next year, but it was quite a flurry of activity there for a while.
That sounds like a be careful what you wish for kind of thing. That's great.
That would be the one thing I would add is I doing it all over again. That the timeline would have been the timeline, but I wish we brought in a couple more people into the fold, because I think raising the money, in all honesty, was the easy part. We had great partners, Eric, Nishka, and myself. And a great team, and so. In a way, now it seems like it was the easy part. I think the hard work is really putting that money out. We're doubling our grant making over the next 2 years, and that's, without adding positions or staff, and really keeping it lean. And that would be my advice is just plan accordingly if you're going to increase your grant making.
Oh my goodness.
Luckily, that's someone else's job, right, Mayanne? That's not our job.
I'm sure you're part of it. Wow. Well, this has been an incredible conversation. We're not really wrapping it up, but for anyone for whom this was all that you were up for, we're glad you came. But now we're going to get into some nitty gritty, and you can ask all of your technical questions. I think the first one that I was going to ask, for Eric was really about more of the details of the financial structure. That was what someone wanted to know. So for those of you who want to stick around for that, we are going to keep on going. So stay with us. Eric, someone wanted you to walk through the details, the interest rate, how it will be retired and paid off. I think I already heard some of that about, the payment structure, but I think maybe folks wanted to hear that maybe one more time.
Well, Mayanne,
who said it.
Mayanne
who said it the first time. Yeah.
Happy to take it. So we issued 2 tranches. One was a 30-year, one was a 50-year. We issued $300 million worth of debt that's payable 30 years from now. It's a bullet maturity, so you actually don't have to do anything until the day it's due, which is 30 years from now, and then you have to repay the $300 million. The interest that we paid on that was 2.415%. It's priced off of the 30-year treasury, so it priced 95 basis points above the treasury at the time that we issued the bond. And then on the 50-year bond, it's a $700 million tranche, and we issued it at a 2.815 coupon. It was 135 basis points over the treasury, and that's not payable until 50 years from now. As Eric mentioned before, there's no covenants whatsoever. We have no restrictions. In fact, and our use of proceeds either, we don't really have restrictions on that. But obviously, morally and from a tax perspective, we are using it for strictly for our grant making actually. And then it's a non-callable bond as well, which means that we can't prepay it. You certainly set money aside and fund it internally, but you can't prepay it, or you can prepay it, but it's a penalty. You basically have to make the investor whole for the interest payments they would have gotten for the entire period of that bond. So it's basically prohibitively expensive until you get very close to the end, and then you might be able to retire maybe a couple months early. But basically, it's like a mortgage, right? 30 years from now, we pay it back, and we can't really refinance it.
Interesting. So there was a second question that I think is a follow-on to this. Let me see if I can paraphrase it. So the question was, is there any logical reason not to always take out debt, given the thing that you're saying about repaying $2020 with, with the debt? I mean, repaying the portfolio with $2020 with debt that you're servicing for $2050 and $2070.
No, that's a good question. I mean, it's really important for the board to be sort of on the same page when it comes to your approach to debt. And for us, part of it was driven by the size of the bond offering we were making, because it was such a large sum that it just made sense to have it payable as far out into the future as possible. But that comes with, those consequences that we're saddling future generations from now to deal with this 30, 50 years from now. We also know that in the immediate sort of or medium term, we probably won't be able to access capital markets again if we needed to, right? So if we needed to address another COVID or something similar to it, we probably likely would not be able to do the same thing, right? We would have to, and we are further hampered because now we have, a large debt, outstanding debt on our balance sheet. And so that sort of, creates its own sort of restrictions as well. So, it made sense to issue 30 to 50 year money because the the interest rate environment was so low. It really, that was one of the reasons we thought that it was a good moment in time to issue very, very long-term debt. Mellon just issued, I think it was a 7-year bond that, they're paying 95 basis points. I mean, they're almost paying nothing, but, again, they have to repay it in 7 years, right? So, but it was a much smaller bond, and relative to their assets, it's much smaller too. So it's something that they can, repay 7 years from now. I think it's 100 million. So, I don't know if it's 100 million actually. Just don't quote me on that. But okay. It just represented a much smaller amount. And so I think it really depends on, your appetite for debt and the market conditions that exist.
Yep, absolutely. So someone had a question about whether the loan proceeds, you mentioned the $1 billion in your bank account, and someone got curious about whether or not those loan proceeds are earning anything while they're waiting to go out the door.
We put them in an account that's earning basically a risk-free rate. So it's not generating, a lot. I mean, on $1 billion, I shouldn't say it generates nothing, but as Nishka said, we don't invest it in something other than we just put it in, treasuries, basically very low risk, instruments. And we're really not looking to hang on to that money, right?
Right.
We're trying to write checks as quickly as we can.
And we are lobby for it. Go ahead, Nishka.
Our goal is really to expend all the money in 2 years. I think the longer we hung on to it, the more risk that we have, that we would have sort of a debt financed income type of a situation. So we really are just trying to get it out the door as quickly as possible, and that was the mission goal as well, the programmatic goal.
Well, and are all of those going to be grants, or are there going to be any PRIs in the mix? All grants?
All grants.
Okay, all grants.
We have some flexibility to do PRIs if we wanted to, but I think right now it's really going to be mostly large general support grants.
And then someone else was interested in whether you had given any consideration to using an additional billion, that billion, or maybe, another billion you have hanging around for the foundation's impact investing program.
Well, we already have that. That's already an up to $1 billion program that was approved by the board a few years ago. So that is an existing program that is already sort of provided for and has been approved by the board. That is another really significant, Darren big idea that we all worked on a few years ago.
But it's not a $2 billion one, I guess, is what this person was angling at, right? No, it's still the $1 billion, which
we like to think in terms of round $1 billion numbers, right, Mayanne?
We do. And
Eric,
then that program is ongoing, and so, I mean, it's still ongoing, so we still have $1 billion to go.
And what creative stuff is happening in that program, Eric?
Well, they're still in I'd say the earlier phases of building out that program, but the team that works on that for us have innovated already in a number of ways. They've been focused on financial services in the global south and finding ways to make more traditional private equity investments in the US that are aligned with quality job initiatives, often with outside help applied to the companies to structure programs and compensation systems and equity ownership systems for their employees in ways that go beyond what traditional corporate practices have been. We've also been very focused on a diverse manager initiative that over time will probably constitute the majority of what we do in that area in our mission-related investment program, in which we're seeking to identify talent and back promising diverse managers in all asset classes, all geographies, all areas that we can find fantastic people who we think face barriers to obtaining more traditional investment capital. So we want to try to do what we can to break those barriers down.
That sounds terrific. Well, that's great. And so more questions keep coming in. I've got one other one. Someone was wondering, I think I know the answer to this, but about the connection between the Ford Foundation and Ford, the company's stock, and whether you're decoupled and whether or not that presents any additional risk for this long-term debt.
We are decoupled and have been for something like 50 years. We were certainly funded initially with bequests from Henry and Edsel Ford and gifts of Ford Motor Company's stock, but we divested of that stock, Mayan, in the 1970s. Is that right? Or, yep. So we are now a totally independent private foundation. We don't have any relationship, a formal relationship with the Ford family or the Ford Motor Company. We do have a Ford family member on our board. Henry Ford III is on our board, but it's not a family seat. He's just another board member and a wonderful board member. But we have a very good relationship with the family and a close relationship, particularly now in Detroit. And do increasing amounts of work in Detroit. And that is one of the cities that we will be focusing on with the social bond proceeds, in addition to New York and a couple of other places. So very, very strong, close ties, but no formal relationship.
That's terrific. So have I asked you most of the questions that you're getting from all of those interested parties that have been calling you up? What other questions have you been getting?
Well, the only other thing I would say is in my conversations with people who do my job at other foundations, there was a concern that's understandable about how can you justify bequeathing a substantial amount of balance sheet debt to later generations of boards and management of your organization. And I think there's something that's self-reinforcing about that in a positive way for us. We totally understand the moral imperative of justifying a step like this, and it really focused us even more on making sure that the impact we have with this money is significant enough that people who come after us will completely understand. It will speak for itself as a step that made a lot of sense, and hopefully in light of capital market conditions that prevail in the future, it will also be obvious that this was a very attractive opportunity for us to do financially for the reasons that I covered earlier.
Makes a lot of sense. I mean, it is hard to make decisions, that you're not going to have to ultimately deal with the ramifications of, the three of you or Darren or this current board. That's a lot of pressure, and I'm sure you took it very, very seriously. Do others on the line? I know I can't hear your beautiful voices, but Daniela has been feeding me all of your questions as we go, and I'd love to hear more of them. because most of you stayed on this call for the extra Q&A. I'm hearing this is incredible, terrific. It says, obviously you did some scenario planning. So could you walk us through the doomsday scenario? I love that question. I don't kind of want to hear it. So there better be 3 more questions after that, because I'm not ending with the doomsday scenario question. But please do walk us through the doomsday scenario. What was your worst case scenario, friends? How did that go?
Well, I think you have to be mindful of the fact when you have a fixed amount of debt. I explained earlier the reasons why that's attractive in an environment in which inflation is highly likely to eat away at the value of the dollar in the long run. However, if we do go into a period of deflation or sort of depression-like scenario, then having a fixed amount of debt while your assets are shrinking, it can be very problematic. So we wanted to make sure that we weren't borrowing an amount that we thought wouldn't be sustainable in a severely adverse financial environment. The rating agency conversations we had also focused on that. They did careful work to assess the risk profile of this debt we were carrying. I think we all felt that it was a comfortable level for us, but it's certainly conceivable that any amount of debt could become a constraint on an institution, as we've seen in the corporate world, in an adverse scenario for the markets or for the business. So we wanted to make sure that we were not doing anything that we thought wouldn't be able to be sustainable.
Eric and Mayanne do doomsday scenarios for our board all the time. And I do think it's helpful, when we did the pros and cons and the various options for the board, we did show them sort of long-term impacts in actual concrete ways. They showed charts that demonstrated the impact on the endowment over time of paying the interest on a bond like this, or conversely, taking a large sum out of the endowment now to do grant making, and how that would shrink the size of the endowment and the sort of compounding effect that would have over time. I mean, that's all financial modeling and information that we provide to our board very regularly, and certainly did for this transaction, which I think again helps, because it just makes it clear that we're not trying to hide the fact that there are real impacts, and we want them to fully understand what those are when they bless a decision of this magnitude.
Mm-hmm. And you can't predict the future, right? Just like we all could not have predicted we'd be here. Someone else wanted to know whether, I know that you're not intending to do this because you've already played out what your intentions are, but they wanted to know if the interest payments, the debt servicing, I guess, could be counted towards your 5% payout minimum.
So because of the use of proceeds are just strictly going to grant making, we did get initial blessing from our tax advisors that it can count towards the 5%. But again, as we mentioned before, we're not, we are not reducing our grant making to make room for that.
Mm-hmm.
But certainly for other organizations that might structure it differently, it's helpful, I think, in terms of making a financially compelling argument as to why you want to increase your payout now using
Mm-hmm.
debt.
That's great. So if others need that as another potential tick in the pro column for their board, they now have it. That's terrific.
I mean, I would say you should probably seek the advice of your own tax advisors, but our tax advisors have given us a preliminary okay on that.
We have the little asterisks at the bottom of the PowerPoint. Nishka's not giving legal advice.
I'm not giving legal advice.
Tax advice. Eric's not giving investment advice. And I'm not qualified to give any advice. So this is great. I think that we are basically wrapping up. This is absolutely lovely. I'm sure that there are plenty of other deep questions that people could ask, but I think that we have basically covered the ones that have come in so far. So with that, I just want to give you a hearty thank you for your expertise, for your commitment to the sector and the mission, and putting all of that first in this technical financing approach that you have put forward here, and just real appreciation for the time that you've dedicated here with all of us.
Our pleasure. Thank
Thank
you,
you.
Kathleen, for putting it together.
Thanks for having us.
Of course, absolutely. It was fun. Thank you. Take care.
Thank you.
Thanks, everyone. Stay safe.